Welcome everyone to another episode of The Everyday Trader. This is Greg Jensen from Options Animal. Good to be with you again today on November the 10th. Another amazing trading day today. At least if you're bullish today, it's been an amazing trading day. Eric, how are you today?
I'm doing very well. Thank you very much for asking. Things are going pretty well over here. November's played out like I thought it would. October being typically the most volatile, one of the worst months of the year. And then we tend to see a move up into the end of the year. So not always, there's seasonality that happens. One of the things that in particular, this year's the third year of a presidential cycle. We're coming in the fourth. I'm going to share a chart that I got that, I don't have copyrights to, but here's the typical response, the yellow line. This is going through the fourth, first, second, third. So this is...
I'm not seeing anything yet, just so you know.
Well, you should be reading my mind.
Well, I can sometimes. You can have it long enough.
You normally can. Yeah, so I always point out a chart before. Okay, this is some data that's available out there that looks at past midterm elections. And I've been talking about this for over a year. I've actually been talking about it for a decade or more, to be honest with you. That typically the fourth year, this yellow line is the average percent return of the S&P 500. This starts the beginning of the fourth quarter last year. So this is 2023 right here. And here we are going forward. And there's this grayish line is what we are currently experiencing. So here we are. We've had this big pullback lately and sort of a rally. This is just updated as of a few days ago. So the yellow line is the average that we normally see starting in a third year all the way through. Now, fourth years of a presidential cycle tend not to be good. They tend to be more flattish, but they are up. But it's the third year that's usually really strong. And we normally get a big push to the second half of the fourth quarter. So I think playing out from November, December is what we have to go left. And I expect a theme that's going to be more like this yellow line than anything else. I think we're going to have a push towards the end of the year.
Yeah, no, I agree. I think this is seasonality. There's a lot of factors playing into that right now. And to be honest, the Fed is kind of staying out of the way of this potential. I don't think the Fed wants to derail the economy right now. They do still want to slow down inflation. So I think it's set up the potential for probably a bullish move into the end of the year. And then, yeah, next year, as we enter into that presidential election year, that's when the markets can get volatile. And that really comes down to uncertainty. The one thing the markets don't like is uncertainty. And when you've got a presidential election and all of the economic policies that can impact the economy, that unknown causes the market to be a little more skittish. So next year, maybe a little more volatility. This year, probably a good end of the year. Maybe we get a Santa Claus rally this year, and also in anticipation of the upcoming holiday season. So I'm optimistic. My portfolio is positioned relatively bullish right now, and there is opportunity going into the end of the year for sure. And it's not Big Seven.
It's not the Big Seven?
Not just the Big Seven. I think the Big Seven will do fine, but
we'll talk about that. I want to know what you're trading in a second here. But I wanted to just go back to that point that you mentioned about next year and the markets hating uncertainty. And my talk, my sort of thinking is exactly along the lines of you, and that that I've been doing this for a while, looking at what happens pre-election and going back to certainly in 2007 and 2008, we saw some really really crazy stuff that happened in the markets, and I think a lot of it had to do with what happened in the White House. And this is not a bullish or a bearish thing. It's what Greg said, and I think this is the wisdom that I actually picked up from you, probably 20 years ago, is that it's uncertainty that the market really hates. So let's take a moment here and think about next year's election. Now, there's a lot of things to hate about next year's election.
What, two 80-year-olds running for president?
Let me ask you a question. What is uncertain about those two candidates?
To be honest, there's nothing uncertain. We know it's going to come from each one of those two, whoever gets elected.
One thing I know for sure is half of the country, or somebody pointed out more than half of the country, is, depending on which way it goes, is going to be really pissed off. So I don't know which half, but approximately half of all people. But the truth is, it only comes down to 7 states, and really it's only something like 21 counties that are going to make the decision next year as to which president's going to be. Trump's numbers are incredibly strong. And I have no idea who's going to win, Trump or Biden. Numbers are going to change quite a bit. But I want you to reconsider what you said. If it really comes down to those two people, and I'm sure there's a lot of people listening to it right now, shaking their head going, no,
I know.
I'm the same way. Like, really, is this the best we can do? But what is the market going to do if it's those two guys?
As long as the country remains civil in their relationship with each other, I think the markets actually will go higher, because I agree with you that we know what Trump's going to bring to the table from an economic standpoint. We know what Biden is already doing, assuming he still can cognitively function, for 5 years from now.
I got to tell you, Trump is looking pretty good. I didn't vote for Trump twice. I didn't vote for Trump. So he is actually sounding pretty good. And he's not showing up at any of the debates. To me, the debates look like it's going to be who's running for VP. And folks, we're going to spend a lot of time probably talking about this. It's very important that you separate your opinions here and try to be objective. I am objectively bullish for next year. This is not what I want, but I'm telling you that if it comes down to these two guys, the market is going to love it. And I think we're going to have a bullish year.
I think we will too. And going back, not just to the presidential cycle, but going to the economic cycle and where we're at, I think the Fed has done a really good job of threading the needle of this soft landing that they've been trying to do for a long time. And as long as they can keep the debt monster under control, I know that's been one of the concerns about the long-term viability of the debt. We've had guests on here who have talked about that. I'm thinking specifically of Horace's episode when he was on with us and talked about the viability, the long-term viability of us, the sustainability of us paying the interest on our debt load. As long as that stays under control, which I think it will in the short term, definitely a long-term concern. I think the markets are not too hot right now, where it seem to be controlling inflation, but yet the economy is still pretty solid. The consumer's still out there spending money. I mean, we're getting towards the end of an earnings season that, for the most part, came out pretty good. I know there were some better than others. Google's was not a good earnings report. Microsoft's was great, as an example. There's going to be some stock picking that goes on, but I think the Fed's done a good job of trying to do what they've been trying to do as far as controlling inflation without crashing the economy. So yeah, I'm optimistic next year too. Maybe I'll actually have a bullish price target for the first time in a while.
The last time that we did one of these, I talked about using ChatGPT to analyze some of this sort of stuff. And I've really been heading down that path and using that tool quite a bit for all kinds of things. Right now, it's helping me pick some kitchen appliances, but because we're doing a kitchen remodel. So maybe I need your tips on what kind of professional oven to get, because I'm looking at like should I get a Wolf or a Viking or something like that? Anyways,
both of those are good, by the way.
Oh,
I prefer Viking over Wolf, but they're both good.
Well, I think Viking's a little bit more. They're both not cheap, but I think Viking's a little cheaper. So that's good to hear. So one of the things I had to do is look at the S&P 500 going back to 1955 and see how the response the S&P 500 had to Fed policy. And the conclusion, I mean, if you notice where the Fed is cutting, normally we're cutting going into these recession periods. So you look at these gray bars and you see there's a Fed's cutting. And looking more closely, the market actually does start to go up into the recession and then drops down. So the conclusion from this was, if you had to rank Fed hiking, Fed cutting, or Fed holding, which do you think has the best performance on the S&P 500?
Oh, it's when the Fed increases rates, right?
No, it's actually when the Fed holds rates.
When the Fed holds rates, yeah.
Yeah. When the Fed is constant, that has the best market return. And you can look at different time frames to say, does the Fed cutting reduce? Ideally, what happens when the Fed cuts rates, it stimulates the economy and things grow. Should help the stock market. But the problem is the reason that the Fed is cutting rates is because we're probably going into a recession. There's issues. And so it's not really clear the correlation to the Fed hiking rates, because the market has gone up with the Fed raising rates, and the market has gone up with the Fed lowering rates. Those are the general trends. In all three cases, the market tends to go higher, but the one that by far is head and shoulders above others is the Fed holding rates. And the reason goes right back to what we just talked about with presidents. It is all about uncertainty. And when we're confident that the Fed is not going to be changing rates, that we think we're going to be in a holding period for a while, there's less volatility and it plays out bullishly for the market. There are reasons why it's bad for businesses to have high rates, but if we go back and look, you mentioned earlier that Diane Swonk tweet, which I think should win a Pulitzer Prize.
Yeah.
We'll adapt. People will adapt. Businesses will adapt to these high interest rates. I know we're all screaming now about mortgage rates being on the high sevens for a 30-year fixed mortgage. You know what? People are going to buy houses. We're going to get past it. Maybe they'll rent, but we will all get past this, and people will maintain their standards of living. Businesses with strong balance sheets are actually doing really well. Their interest costs have gone down since the Fed hiked rates because they're making money on their cash deposits. So there will be winners and losers. There are some people, Warren Buffett said that all ships rise with the tide, but when the tide goes out, we get to see who's swimming naked. That's what's happening now. There are some zombie companies that have terrible balance sheets that probably deserve to get beat up. And this is why we've said it's going to be a stock picker's market going from here. When you're in this sort of environment, buy anything, it goes up. When you're in this environment, fundamentals matter.
Yep. So what are you trading between now and the end of the year then?
Okay, so my biggest position, we were talking about this at a time. So my biggest stock position is actually NVIDIA. This is in my active account. I have other accounts that are out there. So number one is NVIDIA. Number two is Tesla. Number three is Apple. And number four is Amazon. Those are my top four holdings right now.
Big seven. Four of the big seven. Love it.
The next one, the fifth one is Albemarle, but that's really a temporary trade. It's a covered call that's in the money. But those are the biggest positions. I mean, I have other stuff open. I've got Foot Locker and GM, and I've got long calls of the IEF, which is the 7 and 10-year treasuries, which are working out pretty well. So those are the equities that I'm trading right now. What about you? What do you got in your portfolio?
So I actually realized, I forgot to tell you, we were talking a little bit before this, I forgot to tell you one of my biggest holdings as well. I skipped it as I was scrolling through. I'm realizing I'm sounding a lot like Buffett's portfolio. My biggest position is Apple. My second biggest position is Bank of America. My third biggest position is Occidental Petroleum. That sounds like Berkshire. Why don't I just own Berkshire?
Yeah, okay, I'll go for it.
But then I've got a position in Square. I've got a position in Roblox, and I actually have a position in silver, also SLV. And that's everything I'm in right now. And Micron. I missed Micron.
Oh, yeah, don't forget Micron. So one of the things we were talking ahead of the show, we wanted to talk about sort of strategies, and Greg was talking about placing Roblox. You just did a trade on Roblox, and what trade did you do? So
I actually did a bearish credit spread on the call side. Now, for those of you who are not options traders, come join us at Options Animal. Come follow us at Trader Oasis. We'll teach you this. We're going to get a little wonky here, so I'm doing a bear call credit spread, but I'm actually bullish with my expectation, my fundamentals on Roblox. But I started it with a bullish credit spread. Now I've already adjusted it today, that's how I started. Was actually with a bullish or bearish trade to play this equity bullishly.
So this is definitely second level thinking. This is a risk analyzer in Trader Oasis that lets you visualize a trade. These are very helpful because it asks some very important questions about your strategy. Where do I make money? Where do I lose money? Where's my break even? What happens if stock price changes? What happens if time changes? What happens if volatility changes? So a lot of those are in there. And this strategy that Greg did is what I call the George Costanza trade. And that is doing the opposite of what you think you're going to do. The stock is going to do. So being bearish when you're bullish. First of all, it's a high probability trade. This trade should normally work. You can see a probability in here, which is based on assuming stocks move in a log normal distribution. You got to take these with a grain of salt, and things get kind of funky when you're way out on the edges of these probabilities. But if you place this trade 6 times, it's going to work 6 times. If you place 10 times, 6 times it's going to work. 4 times, you're probably going to either maybe make less money or need to make some sort of adjustment. And with credit spreads, a very popular strategy that people do is a bull put. And why do they do a bull put? So they sell a put and then they buy a put at a lower that protects them if the stock drops. And the thinking is, what happens if the equity goes down? And the answer is, I'm going to buy the stock. If you're bullish on an equity, you say, well, maybe I'll sell a put down here, and if the stock drops down below there, I'll buy the stock. My cost basis will be 34 or something like that. So let me ask you a question. When do you want to buy the stock? If the stock is rocketing higher or the stock is falling like a rock. So when you do a bull put and you put the trade on, you think, oh yeah, bull put, that's what I want to do. I'll buy the stock. And while it's dropping, I guarantee you, having done this hundreds of times, using bull puts as a way to acquire shares, I never feel good. Do you ever feel good about buying?
No.
No. Now, logically, you did your fundamentals and you know that, hey, there's fundamental value here, and I feel confident that I can collar trade this. Collar trade is a covered call with a long put. There's different variations of that trade. But you can control your risk and you can make your money back. Here's what I do. This is an example. So this is a risk profile. You really should get used to understanding what you're looking at. This is the stock price down here on Roblox. This isn't the trade that Greg did, but this is kind of what he did and how he made his adjustment. So this trade's going to pay off $75. I'm risking $175. Max risk, max loss. Break even is at 40.76. We're rounding to a penny here, roughly. So what do you do? So there's a 64% chance you're going to break even doing nothing. But what happens if the stock starts going higher? You get this massive move up. Well, often, your thought probably was, there's a pretty good chance it's going to pull back from here, right? Was this yesterday you placed this trade?
Yeah, yesterday.
It was working for you. Yesterday it dropped.
It was.
Then today it's moved back up. Well, with this sort of trade, you can have a very discrete, clear level of when you buy the stock. For me, I buy it at $40 or somewhere between 40 and 40.76. So let me show you what this trade will look like if the stock were to move up to 40 and I add the equity and buy it at $40 a share. So if the stock is trading right here at $40 a share, now my break even is $39.26. So the stock can actually drop down and I'll still make money. And I'm in a covered call with an extra long call. If this thing rockets higher, there's no limit to the upside. So if the stock does nothing and stays below, you make money. If you're willing to buy the stock, you maybe set an alarm or an alert at 40 or something like that. Now, what if it gaps up here? Well, we can talk about that later. Still an easy way to make money from there. And then you adjust into this trade. And then if the stock's gone up, you've made money on that long call, maybe you close the long call. Now, this strategy is pretty straightforward and easy to understand. But just like everything with options, there's multiple layers to it. And what I said is predicated on the fact that you understand how to do a collar. Because you will need to be in a collar, because there's the question, exactly like what happened with Roblox, is what if you did this trade, say at 38, the stock gapped up here, you bought the stock at 42, and now it comes back down here. So what if it goes up, you buy into a bullish trade, and then it goes down? And so you have to understand how to manage a collar, which I think is fundamental. But once you're comfortable doing a collar, I do these trades all the time. Like I said, I call it a George Costanza trade. I do a bearish trade because I'm bullish and because I'm usually wrong.
Yep. No, it's a great trade. I love using it, and I will do a few more between now and the end of the year, I'm sure. Because a lot of those positions I mentioned I was in, next week I may not be in a handful of them because I've got covered calls have gone in the money, and I might find other opportunities. So I think that's one of the key things in trading and is looking for opportunity. Don't fall in love with just the same stock every time and just think, oh, well, my grandma gave me shares of General Electric, and, I got to hang on to those shares of General Electric forever. You've had a horrible 20 years if you've held on to grandma's shares of GE for the last 20 years. And I'm not saying that Apple's in the same scenario as GE was, but man, Apple's as a slowing ship. It's a Titanic. I still love it. I still love their products. I think they can continue to grow, but you got to do your homework. You got to read those quarterly reports. So it is a new picker's market.
Have you seen the new device, the Humane?
No.
Do a Google search, human with an E on the end of it. And it's a pin that you put on your hand. And to see the screen, you hold your hand in front of it and it projects a laser. This is available for purchase now. I think they ship in a week or two. $700. It works on hand gestures. You use your hand to do different things. It looks and it pairs with Bluetooth. This should be Apple. Apple should have created this product. Check it out, the Humane.
I'm just looking at it right now. It looks interesting. I'll have to do some research on it.
I mean, if it wasn't $700, I'd buy it. I'm guessing this version 1.0 is probably going to be a little bit quirky.
It's like when you bought your first, 40-inch or 50-inch flat screen TV for $5,000, remember?
Exactly. I think that's going to be it. I think these things are probably going to be $150 and probably built into your glasses. And it's just the technology that's the ground shift of what's happening right now. The ground is moving underneath us and we just don't feel it but there are major changes in technology, and that product should have been Apple. Apple should have this leap, like what replaces an iPhone. You can't imagine what replaces an iPhone. This takes the need out of it. Now what you need to do is figure out how to implant them. You just surgically put it in your forehead, tie it to Neuralink, and then I'm not joking. I do think there's going to be some serious, more human integrations that are coming down the road. But so I'm very bullish on where we're going, and long term. I think this, Warren Buffett's quote, it's been a bad bet to bet against the United States for 140 years or 240 years. I think that's going to be the same going forward. We live in the greatest country.
Let's be bullish.
Opportunity.
Bullish in the end of the year. Next week, let's get together again. We'll talk about CPI, PPI, retail sales. Could be a big inflation discussion next week. So
just real quick, a couple things I'll throw out. The VIX is crashing down. There is a huge shift in sentiment. If you see, we're down around 14 right now, or mid 14s. Big shift in sentiment there. So a switch turned a week or two ago, and so things are different. That supports the notion that we mentioned about being bullish. And I'm also going to mention a name for people, Claudia Sahm, S-A-H-M. Do a Google search for her. She has worked for the Federal Reserve and has created what's called the Sahm indicator for recession. Everybody's been talking about her because her signal is getting close to being triggered. I think you're going to see her. She's gone viral here in the past few weeks. She's somebody I've been following for quite a while. But it's good to see her getting some attention. So from an economic standpoint, take a look at that. Also, I did record, we got a lot of feedback on the last event that we did, and I mentioned ChatGPT and how I've been using it. I have had a lot of people reach out to me and say, can you teach me? Can you show me how to do that? And so I'm going to have a session that we're going to do here where I'll walk through how I use GPT to analyze stocks.
Cool. Looking forward to it.
Awesome.
Hey, folks, thanks for joining us. Good to see you again. We'll catch you again next week. Talk about inflation. Thanks, everybody.
Bye, everybody. See ya.